Hello friends, in this video I am going to discuss the accounting research program that is taught in the Graduate School of Accounting. And in this video I am going to discuss that why accounting research is required, and it's required and done by what kind of the accounting people. So after going through this video, you will be able to identify the parties who perform the accounting research and the circumstances in which accounting research is required. You will be able to describe the ideal timing for performing accounting research and understand circumstances in which the timing may not be feasible. You will be able to understand that different standards apply to different research environments, example financial, governmental, audit, tax, and international research. And you will also be able to identify key standard setters involved in establishing US accounting guidance. Let's discuss what is accounting research and why is it performed. The term accounting research is used to describe two very different types of research. Research done in practice and the academic research. The research that is done in practice by accountants and other interested parties, often in conjunction with the preparation or review of financial statements or tax returns. And the academic research primarily done by the candidates who are pursuing or have obtained a PhD in accounting. This course focuses primarily on the applied research, also known as the technical accounting research, which is done in practice to account for the transactions in conjunction with the preparation of financial statements or tax returns. Additionally, the key objective of accounting research is to create robust documentation supporting the conclusions reached. Proper accounting research documentation summarizes in one place all relevant background on an issue, the guidance considered, and the basis for selected accounting position. Documenting the basis for accounting positions is especially critical in circumstances where the accounting for a transaction involves judgment. For example, if two or more alternatives are present. Accounting research is generally only performed for transactions and events that are considered material to an entity, and that are therefore relevant to users for an entity's financial statements. Let's see which parties are the ones that perform the accounting research. Over here you see there are corporate accountants, auditors, regulators, investors, and attorneys. Out of 5 of these, auditors are the people who mostly do the accounting research. Corporate accountants do the accounting research before a transaction occurs, and the auditors do the accounting research after the company documentation is prepared. Accounting research can occur at different stages in financial reporting process. Ideally, companies with sufficient resources, often the public companies, will research accounting for a transaction before the transaction takes place. However, the accounting research process may differ for small or non-public companies, which may be subject to more resource constraints and which generally have less user demand for financial statements. In these environments, research may only occur as financial statements are being prepared, or it may occur at the request of an auditor seeking further support for the company's accounting methods. Performing an accounting research before a transaction occurs is beneficial for few reasons. This research allows the company management to evaluate whether the expected financial statement impacts of the transaction as drafted are acceptable. It allows the management to adjust forecasted earnings to reflect the expected impacts of the transaction. It allows the accounting team to prepare timely documentation of the expected accounting position. And it also allows the audit team to review the proposed accounting treatment before the transaction is recorded. Corporate management teams are frequently on the lookout for business opportunities that are profitable and aligned with their company's strategic objectives. While management evaluates the merits of a potential transaction, the company's accounting team should be engaged concurrently to evaluate the accounting implications of the transaction. Management will take the expected financial statement impacts of the transaction into consideration when assessing whether a transaction is worth pursuing. Here are some examples of the transactions that may be researched before their execution. Investments, sales of new products, partnerships with other entities, lease agreements, sales of land, property, and issuance of new class of equity, debt, or hybrid securities. Researching a past transaction. When it's not possible to research a transaction before its execution, accounting research may be necessary at the time or after the transaction occurs. The purpose of this research is simply to determine how to record the event in financial statements and to document this determination. This may be necessary if the company has limited accounting resources or small operations. New information becomes known about existing financial statement accounts or estimates. The transaction is confidential, time sensitive, or could not have been anticipated. Final contract terms differ from draft terms. Or the research may be performed after financial statement issuance. This may be necessary to respond to regular inquiries, investor inquiries, and litigation. Research can be performed after the financial statement issuance or preparation. After the financial statements have been prepared, the accounting research may be performed by various parties as follows. Investors may research a company's choice of accounting methods and may seek to understand alternatives available in the literature. Using this information, the investors may choose to adjust their internal models to improve consistency across companies they are evaluating. Regulators, such as SEC or other industry-specific regulatory agencies, periodically review the amounts and disclosures presented in the financial statements of the companies they oversee. To assess whether a company's accounting judgment and disclosures are appropriate, regulators may perform research to familiarize themselves with accounting requirements. Attorneys may perform accounting research in order to argue that the company's financial reporting has harmed an investor or other interested party. Now let's discuss in what environments the accounting research is performed. Accounting research is performed in a variety of environments, including in public and non-public companies, domestic and international, governments, and for the purpose of researching tax requirements. Public companies. Example, companies that issue publicly traded debt and equity securities are generally required to file financial statements with SEC. By contrast, non-public or private companies are generally not required to file financial statements with the SEC. However, financial statements may be necessary to satisfy lenders, venture capitalists, or other stakeholders. In both cases, research is frequently necessary to ensure that the financial statements have been prepared in accordance with all applicable accounting standards. Outside of United States, accounting research is performed by public and non-public companies as required by their national laws to issue financial statements. Many non-US countries prepare their financial statements in accordance with IFRS, that is the International Financial Reporting Standards. Other companies continue to follow country-specific financial reporting guidance. Governmental entities including state, local, and federal governments and agencies are frequently required to prepare financial statements to demonstrate how they have used the funds allocated to them. Accountants involved in the preparation of governmental financial statements must be able to research and understand requirements for their preparation. Tax research is performed by corporations or for corporations and other entities that consider tax consequences in planning transactions and that are required to report their activities to the government body. To understand the tax reporting requirements and to take advantage of all available tax incentive programs, researchers must become familiar with the tax research sources ranging from IRC to court decisions. Let's focus on this slide for a minute. This slide shows the standard setters for each research environment. Private companies. The standard setter for private company is FASB, the Financial Accounting Standards Board. Consulting the Private Company Council, PCC. Auditor type is Audit of Private Companies, and the standard setter is AICPA. Public companies. Standard setter is FASB and SEC. Audits of public companies. Standard setting body is PCAOB. Must also follow AICPA Code of Conduct. Governmental entities, state and local. Standard setting body is GASB. Government Accounting Standards Board. Audits of governmental entities, state, local, federal. GAO issues the Yellow Book. That's the Government Auditing Organization. Governmental entities, federal. Standard setting body is FASAB. And for the auditing, it is GAO. International companies. Standard setting body is IASB, International Accounting Standards Board, or the local standard setter for non-IFRS countries. Audits of the international companies, IAASB, or other local standard setter. This slide shows the sources of tax research guidance. The individuals who perform tax research must consult multiple sources of guidance. These include statutory sources, which is IRC, Internal Revenue Code, other statutes with tax-related provisions, example the Bankruptcy Code, administrative sources, Treasury regulations, IRS revenue rulings, written administrative agency determinations. Judicial sources, U.S. Supreme Court, U.S. Court of Appeals, U.S. District Courts, and U.S. Court of Federal Claims and Tax Courts. Following is a timeline of primary standard setting bodies and guidance they issued. Committee on Accounting Procedures, CAP. It issued accounting research bulletins in 1939. Accounting Principles Board, APB. It issued APB opinions until 1962. Financial Accounting Standards Board, FASB. The FASB Statements, 1973. FASB codification established in 2009. Today, the codification is the sole source of authoritative GAAP for non-governmental entities. All guidance in the codification has equal authority. Let's review the early standard setters to whom the SEC delegated standard setting authority. Committee on Accounting Procedure, CAP, formed by AICPA, existed from 1939 to 1962, published accounting research bulletins, ARBs, not mandatory. Accounting Principles Board, APB, formed by AICPA, existed from 1962 to 1973, published APB opinions, not mandatory initially. APB opinions became authoritative when the AICPA began requiring disclosure for departures from GAAP. Criticisms of these early standard setting bodies. No conceptual framework, decisions were made on one-off basis. Part-time board members, not independent, acted more for the needs of their full-time employers. To remedy these concerns, the CAP was replaced by the APB, and later in 1973, the APB was replaced by FASB. Financial Accounting Standards Board. It was formed in 1973 and it is still active. Overseen by the Financial Accounting Foundation, FAF. Guidance issued by the FASB is authoritative and must be followed to get a clean audit opinion. That is, both the AICPA and SEC recognize the FASB as a body with authority to set accounting standards. Funded through the accounting support fees assessed to public companies collected for the FASB by PCAOB. Companies pay their share of the fee based on the size of their market capitalization. The PCAOB is also funded through these accounting support fees. Public versus private company GAAP. The U.S. public and non-public, that is private companies, are generally subject to the same set of accounting standards, GAAP, with certain exceptions permitted for private companies. Public company or public entity is defined in the code as a business or not-for-profit entity that is required to file financial statements with SEC, issues publicly traded debt or equity, or provides financial statements for the purpose of issuing any class of securities in the public market. Non-public entities are generally defined as entities not having the characteristics of public companies. The changing environment for private companies. In 2013, another private company alternative was introduced by AICPA, the Financial Reporting Framework for Small and Medium-Sized Entities, FRF and SMEs. This framework is intended to streamline the preparation of financial statements where a clean audit opinion is not required. This is a non-GAAP framework and also known as Other Comprehensive Basis of Accounting, OCBOA.